What's up, everybody? It is Tuesday. It is 6 p.m., which means it is time for office hours Q&A. Flying solo here for a minute. Serena will be here. He's in the middle of a call with the clients, but she will join us here in a little bit. But I thought I'd entertain you guys until that happens. So this is office hours. I am Neal, founder, chief tax strategist here at Tax Sherpa, and what we do is we help small business people, solopreneurs, independent contractors, freelancers save tons of money on their taxes. And that extends to people who have day jobs too, but fundamentally, you need something on the side. And the reason for that is because in the old days, say pre-2017, there were a lot of things you could do in an individual tax return as far as generating tax savings. And the Tax Cut and Jobs Act got rid of most of them. The real power is on the business side. So we're refocused on helping people save money. Most of that is on the business side. So it can be done with a big job. Just need some kind of business of your own as well. I like to take lots of different forms. But this is office hours. This is where we answer questions that have come in over the last usually week or so. Answer and ask me all those. If this is your first time here, that's generally how it works. But we're still waiting on her. So until then, let's get into a couple things. First, I'll take you through our normal kind of intro. This is me, my story. I realized early, and by early, that means in the year 2000, 24 years ago, that the corporate world was not for me. And then by 2007, I was owing the IRS $1 million. And it sounds crazy. It sounded really crazy. And like most people, I stuck my head in the sand and I ignored my tax problems. They got worse and worse. And by 2009, they started garnishing my paycheck. And that's when I actually decided to fix my problem. I ended up finding a former Wall Street tax attorney who ended up becoming my mentor. So fixing my own problems, I got into the tax game and learned from a perspective that is not what most people experience in the tax world. Because I came to it from the entrepreneurial side, it's always been about what can we do in order to save money? Because taxes, especially for small business people, are typically the single largest expense that we have in our lives. And if we can reduce that, creates margin that we can apply to other areas. And over the past 15 years, worked on over 50,000 tax returns and billions of dollars worth of revenue and saving millions and millions of dollars a year. And I'll move my head out of the way here. And so the mission has become to help my tribe of solopreneur small business owners get their quality of life back by saving their taxes. And we'll get into that a little bit here. But I love this quote. The quality of our questions determines the quality of our life. And it's attributed to Tony Robbins. I wasn't there when he said it, but I'm going to go with that attribution. So my question is, what is the root problem with overpaying on your taxes? In fact, we're going to go into some announcements that the IRS put out today that will talk about payments and those kinds of things. And it's an option. There's plenty of court history. There's a famous case with Justice Learned Hand, which is a crazy name when you think about it. And basically, the court case, and this goes back decades, says that people are under no obligation to arrange their affairs in a way that advantages the government and makes them have to pay more. Equally, they can't arrange their affairs in such a way that is just for tax purposes, meaning that, like in business deductions, this comes up a lot. It's like you have to have business purpose for doing the thing that you're doing. And if you have that, then you can arrange your affairs in a way that minimizes your tax burden. Great. But you don't have to. It's optional, to be honest. And a lot of people, I would say virtually everybody, is overpaying all their taxes because they're paying more than they need to. So what's the problem with that? If everybody does it, the problem is you're wasting 74 days a year. That's the real problem. And that comes out to 20%. And I picked that number just because it's a very typical result that we see. Look at before and after when we total a person's total tax liability, income tax, payroll tax, and self-employment tax, additional Medicare tax, all that kind of stuff. If we add it all together, usually in a before and after scenario, before we do our work and after we do our work, generally we'll see a difference of about 20% of your gross. And that is significant. And if we equate that to a year, it's 20% of the year, 74 days. So the real problem with overpaying your taxes is that 74 days a year that you're not working for yourself. You're not working for your family. You're not working for your community. You're not working to go on vacation. You're just working in order to create revenue and then hand it over to the government. So that is the core problems. Here's Serena's. It's pretty great. And that is the problem with overpaying. And hey, Serena, welcome.
Hey, Neal, sorry about my camera.
So that 34 days a year that you're spending working for the government, to me, is a waste. And let's waste as little as possible. Let's get that time back for yourself, for your family. Like I said, even if you take all that money and go to Vegas and put it on black, that's still a better use as far as I'm concerned. I have some ideas as far as other uses. Answer to all tax questions that anybody could ever ask. And the answer is, it depends. It depends on what we call facts and circumstances. Facts and circumstances of one case are not going to be the same as the facts and circumstances of another case. And that's true 100% of the time. The fact that it depends does not depend, if that makes sense. Because everybody's life is unique. And what is true for you is not necessarily going to be true for other people. It's the totality of the situation that goes into how things are treated for tax purposes. Before we get into the questions, I did want to go through a couple of announcements that came out from the IRS today. Today is October 22nd, if I didn't say it before. So let's take a look at, they released a bunch of press releases, and this one caught my eye. IRS announces launch of pass-through compliance unit in LB&I. New York brings together teams of specialists from across the agency to tackle large or complex exams. What does that mean? There's different departments in the IRS. LB&I stands for Large Business and International. Large business is defined as makes $25 million or more. International is international. And so what they're saying is that they're restructuring how they are doing exams, which is their word for audits, for pass-through entities. That we've seen some of this chatter from the IRS before. In fact, I referenced some of it here, where the IRS launched examinations of 76 of the largest partnerships with average assets over $10 billion, that it be hedge funds, real estate investment partnerships, publicly traded partnerships, large law firms, and many other industries. These audits could take years depending on the size and complexity of the partnerships. Super. You got billions of dollars worth of funding, you've hired thousands of people, and then IRS Chief Counsel announced the creation of a new associate office that will focus exclusively on partnerships, corporations, trusts, and estates. This office would be drawn from the current special estates get audited all the time. So if you have an estate tax return where somebody passes away and the value of the estate is greater than the exclusion, then those, I think 100% of the time, get audited. Those don't get audited. And S corporations and partnerships get audited very little, but they are increasing their coverage. Now, before everybody freaks out, it's important to keep in mind the perspective here. In partnerships and S corps, there's about 10 million. Trusts are relatively small and estates are very small. We could just round this up to 10 million. And even if they increase their audit coverage, it's still not going to be a significant percentage. So it still pays to structure your business through a partnership or an S corporation, usually an S corporation. And sometimes we'll talk about in detail about why that is. But the other thing that was interesting here is that they are restructuring. So before pass-through exams, which is S corporations, partnerships, trusts, and estates, were divided between LB&I and the small business self-employed division based on the size of the entity. It's that 45 million threshold. Going forward, revenue agents and pass-through field operations will be assembled into geographically based teams that are responsible for primary exams of the pass-through entity returns. LB&I will be responsible for starting pass-through exams regardless of entity size. SBSE will continue to examine pass-through entities as part of related exam of a tax return. So basically, the large business unit is being tasked with starting the exams of all these different entities, which is an interesting way to go. I tend to think that will actually diminish the people who are in small businesses getting audited, because you got to think, so there's some agent in this department and they're looking at different files that say, hey, this partnership is doing $56 million a year in revenue. And this partnership over here is doing 172,000. Which one am I going to spend my time auditing? Probably going to go with the 56 million. We might actually see audit rates go down on small business because of this. So that's an interesting topic. That's for sure going to happen, but it is a possibility. So yeah, and I use the Inflation Reduction Act funding. That was the thing that gave them their billions of dollars to hire 80,000 agents. We were able to reverse our historically low audit rates for complex arrangements employed by certain high wealth individuals at large entities. And yeah, so they got 76. Great. Congratulations, guys. All right, so that was press release number 1 I wanted to go over. Press release number 2 I wanted to go over was fake charity scams. And this is just the this actually came out last week, but we had these hurricanes built into Colleen, and the IRS is saying, hey, watch out. There's scams out there. People set up fake charities and they look good and all this kind of stuff. So there is a tool, the Tax Exempt Organization tool, TEOS. So you could search for different entities by ID number, by city, by state, all this kind of stuff. And so basically you want to check out somebody asking you for money, make sure they're real. That's all it's saying. I actually agree with this advice. There are scammers out there. So just be careful when giving people money, because even if they are an actual charity, you'll still have to be careful, because a lot of times that money that you're giving does not really reach its target destination. There's the Charity Navigator is one of those watchdog organizations that kind of checks up how many dollars, like if you give $1, how many cents actually reach the cause versus marketing and administrative and all this kind of stuff. So you got to be careful when you're donating to charity, which is why, amongst other reasons, like if I go to a random store where they're saying, hey, do you want to round up for charity? I say no, because I don't know what they're doing with that money. It's not because I don't like sick kids or whatever the cause is. It's because I don't trust the store. I could give money directly to an organization as I choose. That is your public service announcement for the day. And then the third thing that came out, this one also came out today, was the adjustments for tax year 2025. Every year they adjust the numbers and the bracket, all these kinds of things. So I thought it was worth going over for a second here. So if you are single or married filing separate, the standard deduction next year is going to be $15,000 even. A lot of these came out even, which is interesting. For married filing joint, it's been even $30,000. And if you are head of household, it's $22,000. So that's the standard deduction. So that's basically, you calculate your adjusted gross income, you subtract your standard deduction, and only after that subtraction do you start to reach your taxable income. So basically what it says, if you're a single person, first $15,000 of gross income is tax-free. And then you start to 10% and then 12%. And those brackets got adjusted as well. So we still have the same brackets, but where they cut off is different. So 10%, 12%, 22, 24, 32, 35, and 37. And for single people, it's going to be 11,925. And then it's up to 11,925 for the first 10%, then up to 4,475 for 12%, and then up to 103,000 for 22%, and so on. And the numbers are different if you're filing jointly, all that kind of stuff. We'll skip over some of this other stuff. Earned income credit is up to 8,000 potentially if you have 3 kids that any qualify for max stuff. The foreign earned income exclusion is up to 130,000 this year. The state tax credit is basic exclusion of just under 14 million, which is going back to the estates getting audited. Basically, if you pass away and your estate is worth less than 14 million, then you are under the exclusion amount, at least federally. Some states have different numbers, and you will not have to worry about estate taxes. The estate tax raises virtually no money. It's a complete waste of time, but it employs lawyers and accountants. So there's that. It is what it is. So those are the announcements from the IRS, mostly from today, that I wanted to go over. So I do have a tool that I made for comparing 2023 to 2024 income and the tax rates. I'll make one for 2025, and you can see how the inflation adjusted brackets affect tax. So you can put in how much you made in 24, and then you can say, well, if I make the same in 25, or if I get a raise or whatever, then you can see how the tax burden shifts. Because one of the things that these notices put out, if you actually read through this, a lot of the language reads like, we've inflation adjusted the brackets. So that kind of suggests that if I make the same, but in adjust for inflation, I'm paying the same. And that's not exactly what it means. It means that your taxes go up by the rate of inflation. So last year was a 5.3% adjustment. And this year, I forget what the number is. It was lower. It's like 2.8 or something like that. I'd have to find it in all this. But I'll make that tool for you so that you guys can plug in your numbers and you can see different scenarios of what your tax would be with 2024 numbers versus 2025 number. Okay. So that is actually the end of the announcements that I wanted to go over. So back to the questions and the answers of everything depends. So Sarita, what do we have going on this week as far as questions?
So we have a question from a client about the dust rule. So the client has 2 properties, right? One is their primary home, and the other one is the second home they live in. and two different addresses. So they wanted to know, is it possibly, is there a possibility to use a Augusta rule for both properties, or is only allowed one property per business? Okay.
The way the code reads is that it's your primary dwelling. So it would have to be the one you live at, and that's where your home address is listed as. So a secondary dwelling would not qualify. So that's where it doesn't depend.
I was going to say, yeah, that means it doesn't depend on this one, this question. And then another question they asked was just how to do the recording. Like, how do they make sure that when they do the Augusta rule that they're doing it legally and not doing anything wrong?
You can use our Summit Strategy Sessions blueprint. So that would be number one, where we have all that mapped out for you. But fundamentally, what you want to do is you want to create records. When the IRS does an examination, which is again the code word for audit, almost as 90+% of the time, what they get people on is not anything like real. It's paperwork. People don't keep their records in good order or at all. And then the IRS just goes, shoots and disallow because you can't prove that you did this thing. You want to keep records. And in the case of the Summit Strategy Sessions, what you want to have an actual rental agreement. You want a recording of what it is you did. So the way we structure the Summit Strategy Sessions is you have a business meeting. Other people will talk about you can have a promotional event. Well, it's too close to the line for me. So just have a business meeting, which you should be having anyway. So take one day a month and have management meetings with yourself or with your spouse or whoever else is involved in the management of the business. And you actually go through your books and document, okay, we discussed this, we discussed that, we discussed something. We reviewed our plans from last month or last quarter, and here's how we did, and here's what we tracked. And here's our rationale as to what worked and what didn't and why. And then here's our plan for the upcoming month or quarter or what have you. And then each of your quarter, then that creates your reporting. And that's as simple as that. So actually have a meeting with yourself, because most of our clients there's this sole owner where there's a single manager / decision maker. If it's a husband, wife team or whatever, and have everybody involved. So go through all of them. You record what actually happened, record why things happened, record what you plan to do now. And then, as you do that throughout time, you can then look back and you can say, okay, in July, we planned to do this. In August, we looked at our results and we figured out this worked, this didn't work. We're going to do more of that. We're going to do less of this. We're going to try this new thing. And that creates a real record of what happened throughout the year and is very strong when it comes to examination. That's the way I would do it. And that's all built into our Summit Strategy Sessions tools, which if you are in the Navigators group, you get as part of everything. Well, that's a reason to join the Navigators.
Yep. Let's see. So we have a 1031 exchange question, Neal. Oh, this is a cool one. Client wants to know, can the taxpayer conduct a partial 1031 exchange where only part of the sale proceeds are reinvested? And how does this affect the tax deferral?
Yes, you can. You can do part. And the part that is not deferred becomes taxable. It's really that simple. So they consider that boot. For some reason, that's the legal term. So basically, you talk to your 1031 intermediary, a certain amount of funds go to the intermediary, and you talk to them and say, I'm going to be taking some out for personal use. And they'll say, okay, that's going to be taxable. So yeah, I understand. And then you just pay whatever capital gains tax, if any, on that portion. So obviously it's going to depend on the numbers, but basically you're going to pay taxes first, if that makes sense. It's going to be arranged in such a way that money, your basis kind of goes up from zero, absorbs that 1031 money, and then your money that you take out is going to be as taxable as possible. And so what that's going to depend on is what your basis in the property you sold was. So just to give numbers to an example, let's say you had basis in the property of 300,000. You sold it, you made 500. So you had 300 cost, made 500, and you took 100 out. So there's 200 profit. You took 100 of it, you rolled over 400. Okay. The 400 is going to count from the bottom. So it's going to count up for the 300 of cost basis, and then the 100 of profit. And then the 100 you take out is going to be that last portion. That's 100% tax. Does that make sense? But yeah, you just coordinate with your intermediary and then they'll take care of that. And that should all be documented on the like kind exchange form, which is the 8829. or no, 88, now I'm blanking on the form number, but whatever. The like had 88.
So it is a good thing to do a 1031 exchange.
If you plan on keeping your money invested in real estate, that's definitely the way to go. The difficulty is when you're 20 years into this process and it's like, I want to sell everything, then we're going to charge tax code because your basis just carries forward from that initial property. So in 20 years, you might have $10 million worth of real estate and your basis is only $200K. And do I really want to pick up taxes on $19.8 million or whatever the numbers are? It's like a lot of people feel stuck at that point. But there are strategies to deal with it. At the point, they all have costs.
Wow, that's a lot. Think about it. If it was those numbers.
So this gets back to the buy, borrow, die strategy, which works phenomenally well. But you got to go through all those steps. You got to buy, and then you got to borrow, and then you got to die. It's not buy, borrow, sell. So basically, you tap your equity through refinances of some sort or another, and then that's tax free. But then you leave the estate to your heirs, and they can deal with it at that point. And they, under current law, which is under threat, but under current law, they get a step basis, and nobody has to pay taxes ever. But yeah, that's the core elements of that strategy.
And do you see it changing anytime soon, or maybe 7 years from now?
So the Democrats have actively talked about multiple elements of that as things they want to change. They want to limit 1031s in terms of number of transactions and dollar amounts of deferral. So what they proposed in the Biden budget from the beginning of this year, they said they want to limit 1031s to one exchange per year, so you couldn't do multiple. And they wanted to limit the gains to 500 grand. And if you had $1 million gain, you'd be able to exclude 500, but then you'd have to pay tax. So that's already been proposed. They've also talked about, but I don't think I've seen it as a formal policy anywhere yet, that they want to eliminate the step-up basis, which would be an enormous tax penalty to the middle class. But yeah, as far as will this get passed, we have an election here in 2 weeks, something like that. Let's pretend for a moment that we'll actually get the results of the election on election day. Or so if in 2 weeks we find out that Harris wins, then all these things are seriously on the table, but they do require acts of Congress. So would she be able to get this kind of legislation passed through Congress is debatable. Depends on how the congressional elections go, and it depends on how willing to work with her they are. If the Republicans end up in control of the House of Representatives, then I would say no shot of that happening in the next 2 years. If the Democrats end up in control, but very small control, like 50, 51%, it's unlikely. If the Democrats get a strong majority in the House and the Senate and get the White House, then yeah, could very well happen. If the Republicans win, obviously, probably that's not part of their proposals.
Whatever happened to the real estate commission? It was something that where I think it was the government going after the real estate commissions and how much they were making, or the brokers or something like that. You told me about. Whatever
Yes.
happened with that?
So all of the big brokers settled, and
Okay.
now it's, you have to talk to some realtors, but basically they settled on was that buyer representatives, realtors, their commissions were they're in cahoots with each other because all the brokers coordinated in order to keep prices elevated. And so now if you're a realtor representing a buyer, then you have to negotiate your payment separately. And there's different people trying different things in order to get that done. Yeah, it's a giant mess.
It's wild.
We'll see how that all plays out. Now, what was interesting, when I first heard about this issue, I was thinking about it. And I was like, if I had to look at the total transaction of a real estate deal, I would actually say that the more important realtor between a buyer agent and a seller agent is actually the buyer agent. Because the seller agent, they list the property, right? They publicize it, and fundamentally, you can do that yourself. You can go on that. There's flat fee listing services where you can get your property listed on the MLS, and it's not that hard. And how much marketing does a selling agent? Depends on the property, depends on the agent, but usually not a lot. Usually putting it on the MLS is good, because then it gets picked up by Zillow and Redfin and Trulia and all these other sites. And most buyers find their property listings through one of those sites. The days of sending out postcards and do all this work is over. So a buyer or a buyer's agent is going to come in and look at the property as one among many on behalf of the buyer and say, Mr. Buyer, Mrs. Buyer, you said you wanted this type of thing in your next property. this property does a good job of fulfilling that. This property, maybe not so much. And these are things we need to look out for. These are the things we want to look for in inspection. Here's the kind of negotiation we can do. So to my mind, the buyer's agent does a lot more value added work than the seller's agent does. However, the way the current compensation structure is that the seller contracts with the seller's agent and they have their commission, which is now 3%. So, and the buyer's agent have to come to their own arrangement, of which the market is still trying to figure out. It's a weird situation. And I think eventually the marketplace will figure out a decent solution. And I don't think it'll be all that different in terms of total cost, to be honest. But we'll see. It will take some time to shake out. But that's the current state of things.
That's crazy. Neil, we have a tax planning question on the research and development. So a client wants to know, how can I best utilize the research and development R&D tax credit for my business?
Yeah, you got to be eligible.
Right.
No, people call it the R&D, but it's actually the credit for increasing research activities. In small business, this takes a couple of different forms. Basically, the credit is for, and there's a couple of different criteria. I think there's 4 criteria they have to submit, but it's got to be a new thing. So it can't be like, this thing was purple, now we're going to make it yellow. That's not new, right? That's just a modification on an old thing. It could be a new product or process or something like that. Process is something that's overlooked a lot, actually. And then it's got to involve, the big thing is technological uncertainty. So you can't know what's happening ahead of time, right? Let's say I've got a pair of sunglasses here, right? And I don't know if that's going above camera or not, but I've got a pair of sunglasses here. They have a certain design. Okay, that's all great. And if I change this piece, the nose piece, to be a different shape, is that technologically uncertain? I would say no, it's not, because it's just you're changing the mold or whatever process you use to make this up, but you're not uncertain about the outcome. You're just changing it because it's a different aesthetic for whatever purpose. You know that the machinery is going to work. You know that the molds are going to work because you just have this experience in this particular industry. Now, if it's a matter of taking these sunglasses and instead of making them out of whatever materials, we're going to make them out of, I saw this guy on YouTube who was making sunglasses out of denim and like to include laminate layers, which is, I thought, a weird idea. But that I would say is technologically uncertain. You don't know if it's actually going to stand up in the end. Again, same product, different nuance to it, different result as far as tax treatment goes. Then as far as how to use it, there's a form 6765. And that calculates the credit. And the R&D credit is complicated in terms of there's different percentages that get applied depending on the age of your business and revenue levels over the years, and whether you do the traditional credit or simplified and all this different kind of stuff. But bottom line, it comes out that your credit is roughly 6% of the cost. And it depends on if you have foreign or domestic contractors or employees or supply costs. There's a lot that goes into it. So yeah, you just have to go through the math and make sure that it works out for you. Now, this is under Section 174. And what happened as part of the Tax Cut and Jobs Act, there was a stealth edit to the code, which was super weird. It caught a lot of people flat-footed. Tax Cut and Jobs Act was passed in 2017, at the very end of 2017. And in it was some language that didn't take effect until 2022 with regard to the R&D credit specifically. And so in 2022, the language of the credit changed for software development specifically. So what it said was that software development costs for basically all software development was counted as R&D. So even if you had an existing thing that you were then modifying, it would still count as R&D, even though it may or may not qualify that traditional testing discussing just previously. And you have to amortize it over 5 years, meaning that so normally if it's not software, you have your expense, that expense is a deduction, and then you also get a credit. And you got to do an add back so you don't double dip on the credit. But overall, you get the deduction and the credit. So if it's software, though, you have to amortize that cost over 5 years, and you only get 10% in the first year. And then you get the credit plus the amortization. And so a lot of software companies have been caught up in this gotcha situation where it's, okay, I spent $1 million on my software developers because it's mostly labor and some server costs. I paid these guys $1 million. I only get to deduct $100,000, and then I get $60,000 in tax credits. That doesn't add up to deducting the $1 million. Now, the following year, I get to deduct 200 grand of the million I spent last year. And then it's 200 grand, 200 grand, 200 grand. And then the last 100 grand in the fifth year. In the long term, it works out. But in the short term, it's extremely painful because you're still out the $1,000,000. A lot of companies have been very upset by this. And we've had a few clients that got caught in this that do software development stuff. And it's just a problem. And there is legislation in the Congress that is written to fix this. However, it has not been passed. It passed the House back in January and then got stuck in the Senate. And I actually saw an article a month ago where they said that, yeah, we're not going to do anything on this until after the election, at least. Because if we pass this and it rewards these software companies, then that can only help the incumbents, which is the Democrats. And so we're not going to participate in that. And so basically they're like, screw you. We're going to keep the pain where it is until after the election. So that's where we are with that. So that's a specific thing with software for that particular credit. To be careful.
I know your experience, Neal, you've seen this get totally messed up. Like when people come and try to say, I can qualify for the credit and they don't qualify, right?
So you have to go through these questions and you got to say, you have to ask yourself as a business owner, do these rules apply to my situation? Like it says on the screen, it depends. But you have to make that determination. And then if you can honestly answer the questions, yes, then yeah, use it. You know, if you can't, then don't use it. Not the kind of thing where you want to get caught on, because when it comes to audit risks, there are things that are honest mistakes, and then there's just deceit. And so honest mistakes are one thing. You might get hit with like an understatement penalty, like a substantial understatement penalty, which would increase your taxes by 20%. But if you get caught with deliberate falsehoods, then you're in a lot more trouble and the fines go way up. So don't do that.
Stay away. It was illegal. Right. Yeah. So we have a e-commerce question. So someone wants to know, should I be deducting inventory costs when purchased or when sold? And how does that affect my cash flow and taxes?
Yeah, it's a big issue with e-commerce. Basically, typically the arrangement is that you are going to have a starting inventory level. You're going to have your purchases, which, is going to add to and then you're going to have your ending inventory, which is going to subtract from your cost of goods. And so really what you want to be doing is you want to be deducting the cost of goods of the thing you actually sold. And so what these beginning and ending inventory numbers do are try to get to that net number. But if you can track it on a case-by-case basis, that's actually better. And it should come out the same, but a lot of people don't really keep good inventory records because you want a snapshot of cost value on January 1st, and you want a snapshot of cost value on December 31st. And depending on how your business works, you may or may not have access to that granularity of information. So it's complicated, and you want to be tracking that as well as you can. And also depends on how complex your business is. If you're selling one thing, it's a lot easier than if you're selling 50 different SKUs. Tracking those things line by line is important. And you should have a software system on your back end to accommodate that. But it is not a trivial question. Your numbers is what it comes down to. And then also, if you have a type of business where there's shrink, meaning that either theft losses or you have spoilage. So I remember I had a client years ago, they manufactured perfume and sold it. And every year they would have like a 4 or 5% shrink. And it was just because the stuff spoiled, went bad. I just had to toss it. Got to be mindful of that and track all those things. So, okay, we had 100 liters of waste, and we take that out of however many we buy, and the associated cost with that, and all that kind of stuff. So it's complicated tracking inventory. Any kind of physical business has this extra layer of complication that the more online or more service-based businesses may not.
Do you know of any softwares where they can probably track all that information?
So for accounting purposes, you could do it in any bookkeeping system like QuickBooks or Wave or any of those. The physical tracking, it's going to depend on your industry. And usually there's going to be an industry specific piece of software that's going to work for your particular type of business. Yeah. And if you're doing like an FBA type of business, a fulfillment by Amazon, where you're buying inventory and you're owning the inventory, but it's being held by a third party like Amazon or 3PL or something like that, then you have to make sure that the numbers are flowing from where you bought the stuff to the people that are holding the inventory so that all the numbers match. And again, that's going to depend on each different platform and how they can work with your people. records. So yeah, there are solutions, but it's going to vary by industry.
It just depends on who's using it, whatever software they get.
Yeah,
Right.
basically, that's what it comes down to.
Understood. So we have a QBI question. Someone wants to know, what is the qualified business income, and how does their business qualify to be able to take that deduction?
Right. So the qualified business income is the pass-through profits portion of income, meaning that if you make profits from the business and you take a salary from it, it's only the profit portion. So this applies to all pass-throughs. It applies to Schedule C businesses. It applies to Schedule E rentals. It applies to Schedule E2 S corporations and partnerships. So then we get into the thresholds. So depending on your filing status, there's a threshold value. If you're single, married filing separate, or head of household, it's about $184,000. If you're married filing joint, it changes every year. So I always get mixed up a little bit. But it's like 300. The single is up to 192 maybe right now, and the married filing joint is 380 something. These originally 168 and 363, but then that has adjusted over time. But if you're under that threshold, then you're going to get, and that's total income, just not only the pass-through. If your total income is under those thresholds for your filing status, then you get the flat 20% break on the qualified business income. So let's say you're single, your adjusted gross income is 100 grand, 50 of that is pass-through profits. You get 20% off on that 50. So you're only going to be paying taxes on 40 of that 50. If you're over that threshold, then multiple questions start to come in. So question number one, what's 20% of your pass-through income? And this is by per entity. You gotta look at each thing individually, and then they get blended together at the end. Question number two, what's 50% of the wages paid by that entity to all of its employees? And wages paid means W-2, not contractors. Question number three, what is 2.5% of the asset base of that company? This provision was included to incentivize real estate development companies and manufacturing plants and that kind of stuff that have large amounts of physical assets. So what they do is that if you're over the threshold, they compare the 50% of wages versus the 2.5% of whichever one of those is larger is then compared to 20% of the pass-through income. And whichever one of those is smaller determines your qualified business income deduction. It's more complicated than that, to be honest. Also, if you're under the threshold, you can be in any line of business. If you're over the threshold, you have to be a qualified business. What does qualified mean? That means not specified service or a specified trade or business. And so what they did was they excluded certain types of businesses from the qualified business income deductions. And those are like consultants, lawyers, accountants are excluded, and there's a specified list. And so that's why they're called specified services. And so if you're not on that list, then you probably are qualified. Exceptions to that would be if you are doing brand promo deals. So if you are doing personal endorsements and getting paid as a personal endorser, then that does not qualify. But pretty much everything else does. So the vast majority of businesses do qualify, either because they're under the threshold for needing to qualify, or they are a qualified trade business and not a specified service, a trader business. Does that cover all cases? I think it does. So pass-through profits, under over threshold, if over, qualified versus specified service, and then from there you calculate your QBI. The calculation is complicated, and it took me 5 years to actually come up with a worksheet that actually works for all the different situations and combines up to 3 different entities and all this kind of stuff. Because what can really screw people up is, let's say I have a perfectly structured QBI from company number 1, and then I have company number 2 where I get profits, and that's not structured at all. That skews the whole thing. And sometimes it can eliminate my qualified business income deduction when that is not what I actually desired as the outcome. So it takes a lot of management, and we spend a lot of time doing that kind of work for our clients.
All right. Good. Neal, we have someone that owns a dental office, and they want to know, can I take advantage of Section 179 expensing for dental equipment purchases, and what is the current deduction limit?
Yeah, the answer is yes, you can. So Section 179 is where you are able to deduct the full cost of equipment, the capital purchases, rather than depreciating over a period of time. There's caveats with that. So one is that 179 only applies to the extent that you have profits. So let's say my dental practice has a profit of 100 grand and I buy $150,000 worth of dental stuff, chairs and machinery and whatever. I can only deduct 100 grand under Section 179 because that extra 50 would put me into loss. So that does not work. As far as the total amount able to be 179 in a given year, I believe the current number is 2.5 million. I'd have to look that up, but it's up there, 7 figures. So you would have to have pre-depreciation or pre-179 level of profit for the limit to matter. The limit for asset doesn't matter in most cases, and you just go with the global limit. So let's get into an interesting combo technique that most people don't know about, actually. So let's say we have that example. I have 100,000 net profit before this equipment, and the equipment costs 150. I can 179 the 100, and then on the remaining 50, I can use bonus depreciation. And that bonus depreciation can push you into loss, whereas 179 cannot. So currently we're in a 40% bonus depreciation regime, right? Because that varies by year. And so you could take 100 grand, 179, and then 40% of the remaining 50, which would be 20 grand of bonus depreciation. And so we'd actually end up with a $20,000 loss on net, and then the remaining 30 would depreciate over whatever the lifespan of that asset were. That's something we don't see a lot of. So when people talk about the 179 deductions, a lot of times they'll talk about cars. And this is where you probably heard the things over or under 6,000 pounds. Because if it's over 6,000 pounds, it's considered a commercial vehicle. If it's under 6,000, it's considered a personal or a passenger vehicle. So over 6,000 is eligible for 179, under 6,000 is not. But yeah, so the limits are high. You can do a lot with them if you have the profits to carry.
Alrighty. So I have another question. A client wants to know, how can I deduct vehicle-related expenses for company-owned service vehicles? And is it better to use the standard mileage rate or actual expenses?
That's a great question because people can. If it's a company-owned vehicle, you do not have a choice. It is actual expenses only. If you're doing a reimbursement, so the vehicle is not owned by the company, but it's owned by the person driving it, and then the company reimburses that person, then you have a choice to do mileage or actuals. So in the way that question was framed, the company owns the vehicle directly. Your only choice, which means you don't have a choice, is that you deduct actual expenses. Fuel, repairs, maintenance. Actually took my car to the shop this morning for its scheduled maintenance. Insurance, interest cost, lease payments, all these things are just direct expenses. And the only time mileage enters into it is if you are reimbursing for a personal good. Now, that is, sorry. So that is that we're not talking about Schedule C business. In a Schedule C business, you can still do it both ways, pick whichever method comes out higher. But for any other kind of business, you got to do actual expenses. And you shouldn't be doing mileage on the Schedule C business anyway, because it's just an audit risk.
Oh, yeah. A major audit risk. Just like the food, right? Meals, right, Neal? Yeah.
Yeah. And I would actually say mileage on a Schedule C business is actually a larger audit risk than even excessive meals and travel.
Wow, I didn't know that.
I've seen people come in with like crazy numbers on their Schedule C businesses with the mileage stuff. And I was like, did you drive 50,000 miles? No. Then why does this say 50,000 miles? And it's always like some ridiculous round number, 50,000. Nobody drives exactly 50,000 miles in a year. That means that you are making stuff up. And what you're supposed to be doing is keeping logs, which have an actual number. Even if you drove 50,000, you actually drove 51,852 and not 50,000.
And there's apps out there that can help you track your mileage. So that should make the job easier.
Even if you took you're supposed to log each trip, but even if you just took the beginning January 1st odometer reading and the December 31st, it's not going to add it. It's just not. So be real about your numbers.
Yeah. So do you have time for one more question or that is it?
Let's try one.
Today. Okay, so we have a business setup question. Someone wants to know, would it make sense for me to switch my business to an S Corp, LLC, or another structure to save on taxes?
An LLC is not a tax designation. Legal doesn't designate. Right there, you are confused about something. An LLC can be an S Corp. A corporation can be an S Corp. An LLC can also be a partnership. It could be a C corporation. It could be a distributed entity. A corporation basically only has two choices: C corporation or S corporation. 92% of the time, S corporation is the right way. But there is another 8% where something else is the right choice. So it does depend on the situation. But if I had to flip a coin, I'd go with S corp. Pretty sure. And the advantage to an S corp is that it's a flow through, which means it benefits from the graduated rates, the 10%, 12%, all the different brackets, as opposed to a C corporation that pays flat rate, at least for federal, 21%. And then it also benefits in the way that the profits are eligible for qualified business income deductions, which the other pass-throughs are as well. C corporations are not. And the profits from an S corporation are not subject to self-employment tax, which the other ones typically are. So that combination of factors is why an S corporation is usually the most efficient choice. Like math goes into, you got to look at your individual situation. And if you need help with that, all right. So that is all of the ways it depends, which is a bunch. So what next? As we run out of time, next steps, if you're interested in this kind of stuff, join our Explorer group. It is our free group. We do have a premium group that is the Navigators, but the Explorers group is free. It involves, we got discussion boards, and you have access to a number of our tools and the on-demand learning of recordings of prior events that we've done, things like that. It's super simple. The main thing is that you will get access to a lot of our free tools, and you'll get notified on streams like this, like submit questions and all those kinds of things. So if that sounds like it's for you, go ahead and just fill out the form. It's just name, code, email, and we will get you added to the group, and then you can ask questions on this stream. So with that, I guess we will cut it off here. That is just taxsherpa.com/explore to take you to that page. And we do these every week. You would think after a while we would run out of questions, but we don't.
No, we don't. We'll
It's
have
a long
more
time.
next week.
It's a long time. New questions every time. We'll see you next week, next Tuesday at 6 p.m. Eastern.
Alrighty. Have a good day.